So a few months ago, we went through some slides and we're talking about all the sort of underlying economic factors that we're going to sort of wash through and have some impact on what we do. And so we'll sort of just have a bit of a little recap on that and then talk about the rates. So the V-shaped recovery in spending, to call it a V-shaped recovery, well, that must be positive. V-shape means if the spending intentions plummeted, then it's got to come up to form V just as quickly. And so that's a big turnaround. It's a little hard to see. I've probably got the wrong glasses on. But a massive swing from, just back in April from a -19 plan to cut spending to today, negative or a net plus 20% planning to spend more. That's a swing of 39%. Like that's a massive swing. So we got broad confidence, net confidence about the future is now positive 16. That's a complete turnaround from the start of the year. Lower retail rates have obviously fueled that, and it takes quite a wee while for that to filter through the market. With the last remaining caveat, and we've spoken about it before, and that's just around job security. So job security, while it's improved, it's still not great. But I guess my positive takeaway from that is to see a V-shaped recovery in those spending intentions while job security is still reasonably low. I would say that must be actually quite positive. And then as the job security starts to strengthen, that's only going to add to that. So rather than sort of waiting for that job security to come back online before anything recovered, which could be the case, that hasn't happened. So I would say that's positive. The do-up, we've spoken about this before, and this again feeds back into that sentiment around how people are feeling around money and the future. So we're seeing a surge there, a strong net positive 19% of households plan to spend more on renovations. Like we know that when people feel like the value of their house is going down, they don't feel particularly good about renovating it because it just feels like throwing good money after bad. And also with people looking to buy houses, right? When there's not a positive feeling around house prices, potentially trying to sell a house with some issues is a problem. And then when that turns right around and sometimes it ends up being a positive, like selling a house with issues, all of a sudden everyone wants it because they're feeling good about spending money on property. You guys even notice that? You know how the do-up suddenly become popular? So we're starting to see a turnaround in the sentiment on people willing to spend money on existing houses. So that's an important one. And the big ticket items, spending intentions from furniture and appliances, highest level since late 2021. So that's a massive piece of time to be at the highest level since then. That's a huge turnaround. It comes back to that sentiment. If people don't feel good about replacing their furniture, they certainly don't feel good about replacing their house. So we know that when people are feeling a little more wealthy, that's when they'll spend instead of delaying their decisions. And you see at the bottom there, the upside, so data pointing to existing homeowners feeling wealthy enough now to upgrade and improve rather than battening down the hatches. The investor headwinds persist. I think probably most of us are kind of already aware of this, that the investor market's pretty flat, and I would say it's probably going to remain pretty flat for the obvious reasons. Obviously, interest rates have come down, which is good, but the rental yields are so low that even with interest rates down where they are, the yields are still terrible, right? Add that to the fact that house insurance is going up, compliance costs keep going up, rates keep going up, meanwhile yields keep getting worse. It's not hard to see why the investors haven't flocked back. And then throw into the mix policy fears. So, Labor's already been talking about potential capital gains or potentially the removal of interest deductibility. Again, I think people have lost confidence in policy around rentals. Now, the real topical bit, and this is the bit that I would say is good news, and you'd be like, what the hell's wrong with you, Steve? How can rates go up mean good news? I've been banging on up here for weeks and weeks, probably most of the year now, saying I want to get to the bottom. So the bottom's gone.
Yay.
Yeah. I think it might have been last week or the week before I said if we're not at the bottom, we must be damn close to it. It turned out we were at the bottom. The thing with the bottom is you don't actually know you're at the bottom until you bounce off it, and now you're no longer at the bottom, but you look back and go, shit, we're at the bottom. So it looks like we were at the bottom, and that doesn't mean that now rates just chug straight back up. It just means that we're probably going to maybe go up a little bit, down a little bit, up a little bit, down a bit, and we're not kind of trending up or down. We just kind of go sideways for a wee while. But I think that this sort of from out of nowhere, seemingly from out of nowhere, because it's not from out of nowhere, but seemingly from out of nowhere increase is just the shot across the bow that we've been kind of waiting for a lot of people who are just delaying those decisions. I think we should see some increased motivation off the back of that. I really do. Imagine if you're going to buy a TV, but TVs are going down in price. If your TV blew up, you'd have to replace it. So you just go and buy a TV. But if your TV was just getting a bit old and worn out and it wasn't working as good as it used to, you'd go, well, I need a new TV, but they're going down, so I'll just give it another 6 months and see what it looks like. And so the same thing happens with interest rates and therefore houses. And so all we're saying now is, well, that ability for people just to kind of wait has gone. So why are rates rising? So sticky inflation, not all inflation is down to consumers. Like it's not just because we spend lots of money on things we don't need. Like some of it's out of our hands. Council putting your rates up, that's not in the consumer's hands. Cost of insurance going up, again, not in the consumer's hands. So government spending, they will spend so much. Again, that's not in our hands, right? So there's only so much the consumers can do to control inflation. And where we've landed is, we're down from that 7.3. We're in the band where the Reserve Bank wants us to be at 1 to 3%, but we're at 3%. Yes, that's at the band, but that's not where they want to be. They'd actually rather be at 1% so that they've got, between 1 and 3 to be able to move around. So when we sit at 3%, that doesn't give them any real place to go. So you would say, based on that inflation's come back a long way, but it's still a little bit high. And the more interest rates come down, well, that's only going to add to inflation because, like we've already seen, V-shaped recovery with spending, people are going to spend more money. That means, that's inflationary. We've seen from the business reports that we've got a real positive amount of businesses who plan to increase their prices next year, or they plan to hold more inventory next year. That's all kind of good news, but it's also inflationary. So we've just got to keep an eye on what that inflation's doing. Global warnings, it's not just New Zealand, so there's a comment there about Australia, but it's not just Aussie either. It's basically most Western countries are kind of all in the same state of play at the moment. Margin restoration, businesses have suppressed their margins to survive that recessionary times that we've just had, so what I just commented on. So as demand turns, they're going to raise prices next year to restore profitability, so let's see how that plays out. That's probably not a good thing for rates if you want your rates to be down, but let's see where we land. And the curve shift. So we're transitioning from downward rate cycle to an upward rate cycle. So the emergency lows of, call it money printing, I guess, that's gone. That's gone for now. So the downward leg, as the cycle's ended, the upward leg starts in earnest. So actionable advice for buyers. I guess I've probably already said it all. And that is that if you've been waiting, you've probably waited a little bit too long. So probably now is the time. Because further waiting is going to see probably some increased pricing from here.
And the plateauing of these rates should see that, that's the signal that, like, even if they go up a little bit and down a little bit, let's call that plateauing.
Yeah.
That will be the time everyone realizes, hey, this is the bottom, and so get over that holding pattern and action thing.
Yeah.
Yeah, that's good.
Absolutely, because we've got such short memories in New Zealand when it comes to interest rates. And we've had, about 3 years of just consistent cuts. And that becomes very comfortable for people because, waiting worked before, so I guess waiting will work again. But now we've had that shot across the bow that actually if you've waited, you've probably waited a little bit too long. It's Christmas now, so we can't do much, but come January, anyone who has been actively waiting, they really shouldn't be waiting any longer. I think it should be, I think we'll have a pretty buoyant market next year, I really do.
Just need to fix the job security fear.
Yeah, there's nothing that we can do in this room to help that. But we know that sentiment's turning around, and even when you look at the businesses who are reporting that they intend on holding more inventory next year or intend on increasing some prices next year, that's not a business who's battening down the hatches, so that message flows through to their staff as well. So some staff who might have been wondering, is the business going to survive, or that sort of sentiment will turn around. So it's not just people who have been told they might get laid off, it's people who just feel like they just don't feel that secure. because they've heard enough stories, they've known other people who have been laid off. But if the business sentiment itself is turning around, then that will flow through to the employees. And I don't expect that confidence around employment to just suddenly rocket overnight, but I do expect that it will progressively get better over 26. And that is really that missing piece. It will all eventually drive us into inflation, and then we'll have to put rates up again. But that's a chat for another day. All right, so next year's going to be good. Let's leave it at that.
Loan Market. Make it yours.